Happy Tuesday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Today, of course, is the final day of 2024, so I thought it would be a good opportunity to look back at the year, especially with the domestic economy, which has been in such a bad place and has taken up so many headlines this year. At the beginning of this year, in the first week of January of 2024 on China Update, we discussed 5 areas to follow closely in 2024 in order to judge the economic health of the country. It had been a year since China had abandoned its disastrous zero-COVID policy, and almost 3 years since the Evergrande collapse triggered the property crisis. There was some optimism in the air at the time. Over the last 12 months, however, this optimism has evaporated. Every major issue facing policymakers has intensified. The structural crises, especially around property, local fiscal conditions, and the growth model, remain unsolved. Re-examining these 5 areas from the first week of January only reinforces this feeling. That is what we'll do today. So the 5 areas that we discussed at the beginning of this year were: 1. Can China avoid a deflationary spiral? 2. Will the government tackle the debt deflation spiral with greater stimulus? 3. Can private sector confidence be restored? 4. Will foreign direct investment into China rebound? And 5. Can the government stem the property downturn? On each of these questions, the answer has been negative. Today we'll move through each one, looking at how the government did this year and what the outlook is based on these criteria. If you get some value from today's episode of China Update, don't forget to hit the like button. If you haven't done so already and you'd like to continue following these sorts of updates as we move into the new year, maybe consider subscribing. And Patreon and Buy Me a Coffee links are also in the description for those who want to help keep the channel financially sustainable and also have access to occasional bonus episodes. It is through this financial support that the channel is able to keep going and continue to produce free episodes open for all 6 days a week. Thank you so much. Now, with that said, let's jump into this year of review. 1. Can China avoid a deflationary spiral? Prices for goods leaving Chinese factories have fallen year on year for 26 consecutive months, dropping 2.5% in November last month from a year earlier, and there is little sign of them turning up again soon. China's gross domestic product deflator, a broader gauge of price levels across the economy, has been in negative territory for 6 consecutive quarters, the longest stretch since data has been available in the 1990s. Some economists expect producer prices to continue in negative territory at least through next year, with Nomura expecting China's producer price index to be down 1.2%, while Macquarie estimates a 1% fall in 2025. Bank of America and Goldman Sachs are forecasting producer prices to be flat next year. The problem is that once expectations for lower prices become entrenched, it is hard to turn them around, as Eswar Prasad, professor of trade policy at Cornell University and a former head of the International Monetary Fund's China division, said back in August, quote, "The longer deflation lasts, it becomes entrenched into people's expectations about future economic prospects. It becomes harder and harder to use macroeconomic stimulus." End quote. Which brings us to 2. Will the government tackle the debt deflation spiral with greater stimulus? After months of disappointment from markets with Beijing's limp stimulus measures, with the only jump in stock prices occurring in September from a very low base after news of a big stimulus push, 3 weeks ago the 24-man Politburo said it would implement more proactive fiscal policy and adopt a moderately loose monetary policy next year, the first introduction of such language since 2008. While this did get hopes up for some analysts, markets still remained unimpressed. Xi Jinping appears to be committed to boosting growth through more manufacturing, shifting state-directed investment away from property and infrastructure towards so-called new production forces like semiconductors and EVs. This is why we've seen an explosion in EV production this year. Exports have surged too, while imports, a proxy for consumption, have declined. General Secretary Xi Jinping reportedly views US-style consumption-driven growth as wasteful. However, as we have explored in previous videos, Beijing has seen heavily reduced bang for its buck with supply-side stimulus for years now, and most local governments do not have the fiscal space to continue such policies for much longer. 3. Can private sector confidence be restored? As we can see here, according to the National Bureau of Statistics itself, consumer confidence collapsed in April 2022 when Shanghai and other big cities were locked down to fight the COVID-19 pandemic. It is yet to recover. China's retail sales growth unexpectedly weakened in November of this year, highlighting the urgency for Beijing to further encourage residents to spend, so far to no success. According to numbers collected by Gavekal Dragonomics, a consultancy based in Beijing, corporate confidence has deteriorated over the past year even faster than new orders. One explanation for the shattered confidence from businesses and households alike is due to the bad shape of the economy. Some analysts, however, argue that China's gloom reflects deeper problems. Adam Posen of the Peterson Institute for International Economics has argued that faith in China's policy making was shattered by the pandemic lockdowns, as well as by abrupt regulatory crackdowns on some of China's most celebrated companies. All of this, of course, we followed at the time. Next, 4. Will foreign direct investment into China rebound? In 2023, China reported its smallest annual foreign direct investment since the 1990s. It was hoped that this would turn around in 2024. It didn't. Foreign investment into China has slumped in the past 3 years after hitting a record in 2021. According to the most recent official data from the State Administration of Foreign Exchange, China's direct investment liabilities in its balance of payments dropped $8.1 billion in the third quarter of this year. The gauge, which measures foreign direct investment into China, was down almost $13 billion in the first 9 months of the year. Should the decline continue for the rest of the year, it would be the first annual net outflow of FDI since at least 1990, when comparable data begins. That is to say, the first time ever on record. Domestic money isn't much different. China suffered its biggest outflow on record from its financial markets last month in November, as the prospect of high US tariffs posed more risks for China. Weaknesses in the yuan, China's currency, and local stocks, as well as the nation's wide interest rate gap with the US, are raising the risk of a vicious cycle of capital outflows. Now we look at the area where perhaps policymakers have performed the worst. 5. Can the government stem the property downturn? Despite literally dozens of measures over several months, the answer to this in 2024 has been no. Beijing has introduced a slew of measures to support the property market this year. It's made it easier and cheaper for people to buy homes, while providing government lending to developers so they can finish projects. It has also put tens of billions of dollars aside so local governments can buy up excess properties and make them into so-called affordable homes. None of this has solved the crisis. After a very brief and mild recovery in October, residential sales fell again in November. National used home prices have declined for 39 straight months through October. Indeed, in a December report, US bank Goldman Sachs wrote that new home starts and government revenue from land sales plunged by 60 to 70% from their peak in the 2020 through 2021 period. New home sales and completions almost halved in the latest data. Incredibly, the value of new homes is down over 50%. This is tens of trillions of dollars of value destroyed. At least $30 trillion of household wealth has been wiped if we include damage done to all asset prices. According to Yi Wang, head of China real estate research at Goldman Sachs, in a different report also recently released, property prices in most cities have returned to 2017 levels and continue to fall. So no, Beijing has not turned the property crisis around this year. The crisis now enters its 5th year of festering. Frankly though, it is not surprising that Beijing has failed to turn the property crisis around. The size of the problem is truly titanic. China's real estate bust left tens of millions of empty housing units, as many as 90 million empty housing units, with 31 million fully or partially built but never sold, and the rest were purchased but sit empty. Assuming 3 people per household, that's enough to house the entire population of Brazil. According to a recent survey by City Research, approximately 74% of Chinese households in first and second tier cities owned more than one home across China, while nearly 20% owned 3 homes or more. Filling these homes would be hard enough, even if China's population were growing, but it's not. Rather, it is expected to fall by 204 million people, and that is a conservative estimate, over the next 30 years. Then there is an additional 20 million units which were sold but were left largely unbuilt by developers due to cash flow problems and poor market conditions. The situation for developers are just as bad as households, and we'll touch on that shortly. This is a textbook bubble, and it is still deflating. Indeed, prices in major cities, which will likely suffer far less than poorer regions, still remain very high. In cities like Shanghai and Beijing, the price-to-income ratio, the cost of housing relative to annual wages, has reached staggering heights. Shenzhen boasts one of the world's most unaffordable property markets, where the average home costs 43 times the median annual income. In similar metropolises like London or New York, the ratio hovers around 15 to 20. So China faces the worst of both worlds, a property market that is still deflating, a years-long housing crisis, while at the same time the most populous cities, the major cities, still have home prices that are frankly ridiculously unaffordable. The empty units, however, owned by millions of Chinese across wealthy cities, is the primary time bomb, however. Tianlei Huang, a research fellow at the Peterson Institute of International Economics, speaking to US-based The Wall Street Journal back in September, explained, quote, "Fundamentally, there are not enough people to fill the homes. I don't think the housing oversupply problem has a solution, really. It's the problem of declining demographics. Ghost cities will remain ghostly." End quote. And to quote a Bloomberg economics report from last week, quote, "Economists think both home prices and sales in the country will fall next year. The best they can say, the decline may be slower than it was in 2024. End quote. Others are more pessimistic, however. George Magnus, research associate at the University of Oxford China Centre, believes real estate will be a drag on the economy for at least 5 more years, recently expressing, quote, "We have definitely passed peak property in China. The government cannot do anything to prevent this and can only try to smooth the transition or make it less uncomfortable." End quote. In the December report mentioned above, Goldman Sachs economists see, quote, "no quick fix for the nationwide property sector and expect the downturn to be a multi-year drag on growth for the Chinese economy," end quote, adding that the property sector will likely weigh on China's GDP growth by 2 percentage points in 2025. The team expects the growth drag to linger until 2030. As China's property debt crisis enters its 5th year, there's little indication that distressed developers are finding it easy to repay debt either. Their dollar bonds are still trading at deeply depressed levels, and their debt issuance has nearly dried up. Chinese businesses and households were more overinvested in real estate than Americans were before the 2008 global financial crisis. But the strong role of the government, which has not allowed property prices to fully fall, has caused the crisis to become more of a prolonged illness, with all its systemic side effects, than a sharp shock, an illness which the country will carry into 2025. 2024 has been a big year. I want to thank all regular viewers, those who have been with the channel for a while, as well as new subscribers and new viewers for coming along on the journey this year. There has been a lot to cover, it has been a lot of work, but it has truly been a pleasure and a privilege for me to be able to share these efforts to understand this complex and interesting country through all its vicissitudes in what could well be a historic turning point for the country and the world. It is increasingly clear that 2025 will be a very consequential year, not just for China's economy and its implications for the rest of the world, but geopolitically, as tensions on the trade and security front with the United States, regional actors like Japan and players in Southeast Asia, as well as a deepening trade conflict with the Europeans and relations growing tighter with Russia and others, will likely all come together to spell what will be a significant year of developments in 2025. For those who follow China Update in 2024, I hope you will join us as we continue to follow this country into next year. Thank you so much for all your continued support. I hope you've had a good 2024, and I wish you all happiness, health, and prosperity in 2025. Happy New Year, and I will see you next year.